we have solved these adjusting entries. We have solved these 8 adjusting entries, and our second requirement is to post these adjusting entries to T accounts, meaning to prepare the ledger accounts for all these accounts. You can see that, for all these 27 accounts, and if we have anything new, we should create a new account. So first of all, we will create, say, the cash accounts, and we'll post if there is any related adjusting entries with cash. Okay, so let me show you one. I'm just creating over here, then I will show you one by one. Okay, so here is our so this is our cash, and here it is debit, credit. This is the ledger accounts. Okay, so I'm just merging this one. So now we will start with a balance from the trial balance. So in our trial balance, we have cash debit 30,000. So let's start with that one, and this one is on December 31st, 2018. Okay, this balance. Okay, so this is 12/31, 2018, and our cash balance is saying 30,000. Okay, and now we will see if there is anything related to cash in the adjusting entries. These are the adjusting entries we prepared in the last class. See, depreciation, salaries and wages, interest expense, interest receivable, prepaid insurance, supplies, sales revenue, rent expense, but we don't have any cash. Okay, so that is why our balance, meaning cash balance, would be this 30,000. Okay, so I'm just making it bold and a different color. So this is our balance of cash. So the same way, so this is the shortcut method. So cash, debit, we have posted the balance on the debit side because cash has a debit balance from the trial balance, and we don't have any adjusting entries. That's okay. Then accounts receivable, the same thing again. So we started with the debit balance, and there is nothing over here. So that is why we did not post any of the adjusting entries here. The prepaid rent, we have one. See, prepaid rent, we have started with the balance of 2,000 from the trial balance, and let me show you from the trial balance what we have. See, from the trial balance we have these 2,000. This is the debit balance. Okay, this is the debit balance 2,000, and we are posting this one on the debit side over here. So debit, and then we must look at the adjusting entries. Okay, so if we look at the adjusting entries, we can see that the prepaid rent is credited in adjusting entry number 8. So prepaid rent is credit, so we will credit the prepaid rent. That is what we have done over here. Can you see that? So this is one. So finally we have a credit of 1,000 and debit of 2,000. So finally our prepaid rent has a debit balance of 1,000. Okay, so the same way we have posted all the accounts from the trial balance to the ledger accounts, and if we have any adjusting entries related to or associated with the accounts we have posted either in debit side or credit side. So finally we have got all of these balances. Okay, so all of these balances we have, and after having all the balances, you know that the adjusted trial balance and trial balance is nothing but a list of the accounts with their debit and credit balances. Okay, so we have, see, cash has a debit balance, so posted on the debit side. So in the same way, all the accounts that have debit balances over here, see, we know that the dividend, expense, assets, they have the debit balance, so we have posted them. And these accounts have credit balance, we have posted them on the credit side, see. And these accounts also have debit balance. So finally, our adjusted trial balance has 357,833, both sides, they are equal. Okay, so this is our adjusted trial balance, and then this one is our income statement. Okay, this is not adjusted trial balance, this should be income statement. Okay, income statement, so prepared for the year ended 31st. So income statement is very simple, that we have the sales revenue, okay, less cost of goods sold, and after subtracting cost of goods sold we have gross profit. Okay, now we are subtracting the operating expenses here. So salaries and wages, rent expense, so depreciation, supplies, insurance, advertising. So total operating expense is this amount, and operating income, after subtracting this total operating expense from the gross profit, we got this operating income. And other income or expenses, say for example interest revenue, this is not our main income, main revenue, so that is why this is written under the head other income or expenses. Okay, so and interest expense. So finally we have a negative other income, so 167, and this is our net income. Okay, and the statement of shareholders equity, we started with the balance, the common stock, retained earnings, and total shareholders equity, this one. And there is nothing new, issue of common stock, so that is why it is 0. And net income, we have got this amount, so balance at the end of December, so this is the balance. Okay, then balance sheet. So we have long list of assets and liabilities. So the first one is the current assets, so cash, accounts receivable, supplies, inventory, note receivable, interest receivable, so prepaid rent, prepaid insurance, total current assets. And then office equipment. This is not written under the head current assets. That is why we have separately calculated total current assets, because office equipment is not a current assets. Okay, this is under the head actually property, plant, and equipment. So office equipment and less accumulated depreciation, that is 40,000. So this is our total assets. Okay, this is our total assets. So, and liabilities and shareholders equity. So and again, so current liabilities. We'll discuss about the current and current assets and current liabilities. How do we define them in our chapter 3? So accounts payable, see, salaries and wages payable, note payable, interest payable, deferred revenue. So all of these liabilities, we need to pay them within 1 year, okay, or less than 1 year. So that is why they are current liabilities. And the shareholders equity, common stock, retained earnings. So total, and see that total liabilities and stockholders' equity is 196,883. So they are balanced. So we have the equation balanced assets equal to liabilities plus owner's equity. So what we have done so far is, see, this was a long problem. So we have done unadjusted. So we have prepared the adjusting entries, post the adjusting entries to the T accounts, then post adjusting entries, meaning post the balances and then adjusting entries are posted, and we have created the prepared the unadjusted trial balance. Then we have prepared the income statement, balance sheet, and now our task is to prepare the closing entries and post to the accounts. Okay, so we will create the closing entries and post those closing entries to the accounts, and what will be done after this, the temporary accounts will be closed. Okay, and then we will prepare the post closing trial balance. Okay, let me show you how to close the accounts. Okay, so here you go. Okay, closing entries. So the question is, which accounts are closed at the end of accounting period? The answer is temporary accounts closed. So what are the temporary accounts? So R, EID. So R means revenue, okay? E, expenses. I means net income or net loss, and D means dividend. Okay, so these accounts are closed. Okay, read accounts are closed. So have that in mind. The read accounts are closed. Read accounts are closed at the end of accounting period. Okay, and they are revenue, expenses, net income or net loss, dividend. So now next question. Oh, which accounts are not closed? Which accounts are not closed? ELA. Okay, ELA accounts are not closed. Are not closed. Just have one thing in mind, that ELA doesn't die. Okay, ELA doesn't die. Okay, so what is that? E, equity. Okay, L, liabilities. A, assets. So our next question is, which accounts are presented in the post-closing trial balance? Okay, you see, can you tell me which accounts are presented in the post-closing trial balance?
ELA.
ELA. Yes. So the equity, liabilities, and assets, yes, they will be presented as a post-closing trial balance. Okay. So do you have any question on this? See, temporary accounts are closed and they are revenue, expenses, net income or net loss, and dividend. Okay. And ELA, equity, liability, and assets are not closed. Okay. So now, next question: how to prepare the closing entries? Okay, how to prepare? Okay, number one. Let's see. Number one is to close revenue accounts. To close the revenue accounts, what should we do? Revenue accounts normally have credit balance, correct? So if we want to close them, we need to debit them. Did you get my point? So to close the revenue accounts, the entry should be, see, the entry would be revenue accounts debit and income summary. Here income summary means actually income statement. When we are writing the income statement, meaning when we are sorry, when we are debiting or crediting the income statement, we will write the income summary. Okay, that is what we have done. We know that revenue accounts are closed in the income statement, correct? So that is what we have done here. So revenue accounts debit and income summary credit. So what you will do, you will write all the revenue accounts here. You will debit all the revenue accounts here and you will write the income summary for the total. Okay, then second one, to close expenses. To close the expense accounts. So what should we do? I think you can now tell me. What should we do to close the expense accounts? Pranil, you want to say something?
You'll have to credit expense, but I don't know what you debit.
Yes. So, and income summary would be debit, correct? Yes. And expense accounts would be credit. Got it. Now, after preparing the income statement, we can have either net income or net loss, correct? So first one, to close net income. If we have net income, how should we close that? Net income means income summary has more credit balance, okay, than debit. So we need to close the income summary. So income summary debit. And where should we?
Retained earnings.
Retained earnings, okay. So retained earnings will be increased by net income, okay. So now to close net loss. So if we want to close net loss, what should we do? So we debit retained earnings and credit
income summary.
correct. Yes. And to close dividend, what should we do? When we pay dividend, what happens? Retained earnings increased or decreased?
Retained earnings decreased.
Yes, retained earnings decrease. So if retained earnings decrease, so retained earnings is debited for the dividend paid and dividend is credited. Okay, this is how we prepare the closing entries. You got it? Okay, I'm just making different color. This will be posted on Learn, so don't worry about that. And then to close the expense accounts, it's very simple. Just study this one a few more times. We have already discussed. Okay. So see that these 5 things you have to remember. Just a quick review. If we want to close the revenue accounts have normally credit balances, so debit them. Done. To close the expense accounts normally have debit balance. Credit them. Done. Okay. And to close the net income, so when we have net income, actually income summary has a credit balance, correct? So to close that one, income summary debit and retained earnings debit. The opposite is also true. Opposite means retained earnings is debit and income summary credit for the closing of net loss, correct? Then to close the dividend, just visualize that if you take dividend from the company, your retained earnings is going down. So that is why retained earnings is debited and dividend credit. Got it? Now come to the point over here. Okay. We will prepare the closing entries from where? Okay, from here. See that? Hello guys, are you with me? This is the adjusted trial balance. We have, okay, let me copy this one. And let me show you in a fresh page. Okay. Then it will be really helpful for you. Okay, here is the trial balance we have. Can you see? Everyone, can you see that?
Yes. Mm-hmm.
Okay. So we have all the accounts over here, and we will prepare the closing entries from this trial balance. Okay. So now I'm giving you 5 minutes. Okay. I'm pausing here. So take 5 minutes and solve this one. Okay. So finally we have this post-closing trial balance after closing all the revenue and expense accounts. Okay. So this is done. I'm saving this one and I will post it on Learn. So the balance sheet. We will talk about balance sheet and how to prepare the balance sheet. So in the balance sheet, we normally present what? We present the assets, liabilities, and equity, correct? Balance sheet is actually the presentation of asset equal to liabilities plus owner's equity, correct? So this is the financial position at a point in time, and it will give us an organized array of assets, liabilities, and stockholders' equity. So grouped according to their common characteristics. Okay. So meaning we will make a group of asset liabilities based on their common characteristics, common criteria. Okay. So this is an example of, say, consolidated balance sheet. So we can see that current assets, property, plant, and equipment, and intangible assets. So there are different types of assets over here. So current assets, why they are current? Because we can convert those assets into cash within 1 year or within the operating cycle of a business. Okay, which one is longer? Okay, so and here is the liabilities and stockholders equity. Again, we have current liabilities. Okay, so this means that we need to pay these liabilities within 1 year, meaning within 12 months, or within the operating cycle, which one is longer. Okay, then we have long-term debt, revolving credit facility, okay, and other long-term liabilities. So total long-term liabilities, and here is the total liabilities. Okay, and here it is the common stock, additional paid capital, retained earnings, accumulated other comprehensive income or loss. Okay, so finally this is our liabilities and stockholders equity. So what is the usefulness of balance sheet? See, the first one is assets are grouped according to their common characteristics. Okay, and then grouping provides useful information about the liquidity, long-term solvency, financial flexibility. Correct? If you have less current assets, it means that you have less liquidity. Okay? If you have more liabilities, less assets, it means that you have a problem in solvency, long-term solvency. And we can also assess the financial flexibility of a company by just seeing the balance sheet. Okay, so there is a limitation of the balance sheet. See, the balance sheet presents all the assets and liabilities at their book values. Okay, we don't show the assets value at their current market value or fair value. Okay, we show them at their original cost or the historical cost. This is the limitation. Okay, and there are two primary reasons that the balance sheet does not show the company's market value. Many assets are measured at their historical cost rather than their fair market value. Many aspects of a company may represent valuable resources, but these items are not recorded as assets in the balance sheet. So what is that? Think about the quality of a CEO, the chief executive officer. Okay, so if we have a very qualified CEO, but we cannot measure the intellectual ability of the CEO, or we don't show the intellectual ability of the CEO as an asset on the balance sheet. Do we do that? No, we don't. Correct? So that is one limitation of the balance sheet presentation. And we may have a very good or very efficient group of employees, but we cannot show them on the balance sheet. So this is the limitation of the balance sheet. And the classification of elements within a balance sheet, see that assets, we classify them as current and long-term, liabilities, again current and long-term, and in the shareholders equity, paid in capital and retained earnings. Okay, retained earnings is the amount of earnings that we retain from the net income. Say for example, we have 100 million of net income and we have distributed 60 million, so the remaining 40 million is our retained earnings. Okay, this 60 million is our dividend. Okay, and this one is our retained earnings. Okay, so which of the following is a subclassification of assets in the balance sheet? It's very simple. 15 seconds.
Cash and cash equivalents.
Subclassification of assets.
Current assets.
Current
assets. Sorry.
Yes, it's current assets. Current assets are those assets expected to be converted into cash within coming year or within the normal operating cycle of the business, if that's longer than 1 year. Okay, so it's very simple. So operating cycle of a typical merchandising or manufacturing company: use cash to acquire inventory, prepare inventory for sale to customers, deliver inventory to customers, and collect cash. Or this is the operating cycle. Okay. Elements of current assets. See, the components of current assets are listed in the decreasing order of liquidity. So this one is the most liquid: cash and cash equivalents, short-term investments, then accounts receivable, inventories, and prepaid expenses. Okay, these are the current assets. We can convert them into cash within 1 year or within the operating cycle of the business. This is an example from Nike. See that the cash and cash equivalents, short-term investments, accounts receivable, net, meaning after subtracting the bad debt, inventories, deferred income taxes, prepaid expenses, and other current assets, total current assets. Okay. So cash and cash equivalent on hand in banks, see, bank drafts, cashier checks, money orders, cash equivalents. These are the cash and cash equivalents. So cash equivalents, maturity date of 3 months or less from the date of purchase. See, commercial paper, money market funds, US Treasury bills. The short-term investments, see, held to maturity, trading securities, securities are available for sale. They are also current assets. Then accounts receivable, notes receivable, we know about those. And this is inventories for manufacturer, finished goods, work in process, and raw materials. Prepaid expenses, we know about these. And okay, long-term assets. These are the assets from which we expect that economic benefits beyond the next year or the operating cycle. Okay, for example, if you have a building, property, plant, and equipment, okay, identifiable intangible assets, goodwill, deferred income taxes, and other assets. Those are long-term assets, investments. So assets that are not used directly in the operations of the business, investments in equity, land held for speculation, long-term receivables, cash set aside for special purposes. Sometimes we need to have some cash, reserve cash. Okay, property, plant, and equipment, say land, building, equipment, machinery, furniture, vehicles, as well as natural resources such as mineral mines, timber tracts, and oil wells. Intangible assets, they are patent, copyrights, trademarks, franchises. Are the long-term assets, prepaid expenses. Liabilities represent obligations to other entities or persons, and we also have current and long-term liabilities, and these are the uh, list of current liabilities. See the current portion in the long-term debt. If we have a long-term debt, say 100 million, and we need to pay $10 million installment in this year, then this is the current portion of the long-term debt. Okay. And the notes payable, accounts payable, accrued liabilities, and income tax payable. We need to pay them in the next year. And then long-term debt, deferred income taxes, and other liabilities. So this is the total liabilities. And the current liabilities means obligations that are expected to be satisfied through the use of current assets or creation of other current liabilities within 12 months or the operating cycle, which one is longer. Okay. So examples say accounts payable, notes payable, deferred revenues, accrued liabilities, currently maturing portion of long-term debt. Types of current liabilities: accounts payable, notes payable, deferred revenues, accrued liabilities, current maturity. This is an example. See, we said that so 1 million note payable requiring 100,000 in principal payments to be made in each of the next 10 years. Meaning in every year we need to pay 100,000. Meaning this 100,000 is the current portion of the long-term debt. Okay. So the long-term liabilities that should be satisfied in the next year or operating cycle, which one is longer? Okay. Examples are long-term notes, bonds, pension obligations, and lease obligations. Shareholders' equity. This is the residual amount. Assets minus liabilities equal to shareholders' equity. And it happens, actually, it arises primarily from paid-in capital or retained earnings, and sometimes referred to as net assets or book value. So they include other equity components such as accumulated other comprehensive income. We will discuss this one in the next chapters. So this is the shareholders' equity. We have, say, common stock, additional paid-in capital, retained earnings, and accumulated other comprehensive income. Okay. So there is a difference between the international reporting standard and GAAP. So difference in balance sheet presentation according to US GAAP and those prepared applying the IFRS, meaning International Financial Reporting Standards. International standards specify a minimum list of items to be presented in the balance sheet. US GAAP has no minimum requirements. See that? The difference. And IAS, International Accounting Standard number 1, revised, changed the title of the balance sheet to Statement of Financial Position. Okay, so according to IAS, we are writing Statement of Financial Positions. So we no longer write the title balance sheet, but some US companies use this title as well, meaning Statement of Financial Position. Okay, and balance sheets prepared using the IFRS, meaning International Financial Reporting Standards, often report non-current items first. Okay, non-current items. So US GAAP presents current assets before the non-current assets. Okay, so these are the differences between these two. And financial disclosures at the end of each fiscal year, companies with public securities are required to provide shareholders with an annual report. Okay, and let me show you something very practical. Okay, can you see my screen? Okay, so let's go to the SEC Edgar. Okay, SEC Edgar. This is company chart. See SEC Edgar, and here you can see the company and person local. Can you see that? So we can write the name of company. Say I'm writing the first one, Amazon. Let's go to Amazon over here. See, you can see that filing types, meaning there are different types of filing. Can you see that? The filing 4 for 8K. Okay, there are, see, the 10Q, 8K, okay, the 8K, 4 to 4, B2. There are different types of files the company submits. So we will look at 10K. 10K means annual file, okay? So let's see the annual report. So here we can see different files. So 10Q, 10. This is the 10K annual report. Okay, I click on the annual report. Okay, so see that open file. Okay. Here you go. See, you can see the 10K, and I'm clicking on the .htm. Okay. This is the annual report of Amazon for the year 2019. Okay, so Amazon.com, and if we go to the see what are the items included in the annual report, see that we can have a look on the table of contents. See that item number 1, business. Item 1A, risk factors. Item 1B, unresolved staff comments. Item 2, properties, legal proceedings, mine safety disclosures. Item number 5, this is part 2, market for registrants common stock, selected consolidated financial data. Okay, management discussion, quantitative and qualitative disclosures. So financial statements and supplementary data. Okay, changes in and disagreements with accountants and accounting and financial disclosures, controls. So and then part 3, we have the directors, executives, all of these informations. So and for 10K summary on the part 4. So these are the things we have. So I want to click on see financial statements and supplementary data. Okay, click on here. Okay, so report of independent registered public accounting firm. So this is a report prepared by the CPA firm. So the board of directors and shareholders Amazon.com. So opinion on the financial statements. So they are saying I don't know whether you can see what they are saying. I'm lost. Hmm. Okay, let me go to that. Okay, go over here. See, their auditor is the Ernst and Young LLP. Okay, they are auditors, and they are saying we have audited the accompanying consolidated balance sheet of Amazon.com as of December 31st, 2018 and 2017, and the related consolidated statements of operations, comprehensive income, stockholders' equity, and cash flows for each of the 3 years in the period, blah, 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 this is this. And they're saying, in our opinion, see, consolidated financial statements present fairly. Okay, they're saying, in all material respects, the financial position of the company at December 31st, 2018 and 17, and the results of its operations and its cash flows for each of the 3 years in conformity with US generally accepted accounting principles. So this is how the auditors are saying. And here it is, consolidated statement of cash flow. See that. They have started with the net income. Okay. Then adjustment to reconcile, investing activities, financing activities, these consolidated statements of operations. Okay. This is income statement, net product sales, net service sales. Okay. Total net sales, operating expenses, operating income, interest income, blah, blah, blah. So finally, they have this one, and consolidated statement of comprehensive income, this one. So comprehensive income statement starts with the net income and then adjust for the other comprehensive income. See, other comprehensive income or loss, foreign currency translation adjustments, net change in unrealized gains, reclassification adjustments for losses or gains. Okay, net unrealized gains. So total other comprehensive income, and finally comprehensive income. This is how they are reported. Then consolidated balance sheet. Okay, this company is saying this is a consolidated balance sheet. So we have, say, current assets, cash and cash equivalents, marketable securities, inventories, accounts receivable, net, and others. So total current assets, property and equipment. Okay, goodwill, other assets, total assets, then current liabilities, accounts payable, accrued expenses and others, unearned revenue, then long-term debt. So these are the things they have. And this is consolidated statements of stockholders' equity. This is how they start with net income, then other comprehensive income or loss, exercise of common stock options. So many things. And here is the thing. See, notes to the consolidated financial statements. So we need to give more information about the account balances we have shown on the income statement or balance sheet. That is what they have done. So description of business, prior period reclassification, principles, use of estimates, okay, earnings per share, revenue, how they have calculated revenue. In this line they have discussed about those, and return allowances, cost of sales, vendor agreements. These are the notes to the financial statements. See, and here there's accounting pronouncements not yet adopted. This is the FASB issued an ASU accounting standard update, the accounting for leases. Okay, they have not yet adopted this one. Okay, so this is how, see, many things. There are many things in the annual report of the company that is submitted with the SEC, Securities and Exchange Commission. Okay. So let's try to solve one problem from here. This one is on learn. So the current assets and liabilities from this problem. Okay. So the following December 31st, 2018, fiscal year end account balance information is available for the company. So cash and cash equivalent, accounts receivable, inventories, property, plant and equipment, accounts payable, wages payable, paid in capital. So the only assets not listed is short-term investments. Okay, the only liabilities not listed are 30,000 note payable due in 2 years and related accrued interest of 1,000 due in 4 months. So the current ratio at year end is 1.5 to 1. Okay. So now requirement. Determine the following at December 31st, 2018. Total current assets, short-term investments, retained earnings. Okay. So what I'm gonna do, so the first one is so the current liabilities. Let's see what are the current liabilities.
Accounts payable and wages payable.
So we have, okay, let's see. We have accounts payable 44,000 plus wages payable 15,000. Anything else we have? Anything else?
I don't think so.
Anything here from here?
The note payable?
The note payable is due in 2 years, so this is not current.
Just the accrued interest then?
Exactly. So it is saying 1,000 interest due in 4 months. So this is the current liability. Okay. So this 1,000 should be equal to how much? 60. Okay. Number 2, short-term investments. See, this is the problem is saying the only assets not listed is short-term investments. What does it mean? It means that we will subtract the short-term investment from the total assets, correct?
Yeah.
Or from the total assets, we will subtract all other assets, then we will have the short-term use. So what do we have? The cash and cash equivalent, accounts receivable, inventories. Okay. So actually we need to apply the current ratio formula. Okay. So we know current ratio is equal to so current assets over current liabilities. Okay, that is equal to current assets over current liabilities is, so current assets is 1.5 and 1 equal to, sorry, so equal to what is the amount of total current assets? we don't know the total current assets, but we know that we have current liabilities of 60,000, correct?
Mm-hmm.
And we have this one, we know this. So our current assets would be equal to what? Current assets would be equal to
90,000. 90,000.
yes. So 1.5 multiplied by 60,000 is equal to 90,000 is our current assets. Okay. Okay. So you know that current asset is 90,000. So our short-term investments would be equal to 90,000 minus, we will subtract all that, say 5,000, 20,000, okay, and 60,000. So
85.
5,000, 20,000 minus 60,000. So which is equal to
5,000.
5,000. Yes, the short-term investment is 5,000. And number 3 is retained earnings. Retained earnings. From our accounting equation, we know that assets equal to liabilities plus owner's equity, correct? So assets meaning total assets. So total assets should be current assets plus long-term assets. So we have 90,000 of current assets plus we have, see, this 120,000 amount of property, plant and equipment, that is long-term assets. So 120,000, okay, that should be equal to current liabilities and long-term liabilities. So we have current liabilities of 60,000, we already know, and plus we have this 30,000 note payable as long-term liabilities, which is due in 2 years. So this one plus this one, okay, plus we have, so the owner's equity has 2 parts, correct? So owner's equity has 2 parts. The first one is paid in capital, okay, plus retained earnings. Okay, now let's solve the equation. So 90 and 120, which is equal to 210, correct? 210 is equal to 90 plus we have, see, paid in capital 100,000. Okay, we have paid in capital of 100,000 plus retained earnings. Okay, okay. So now 190 minus 210 minus 190. So it should be 210,000 minus 190 is equal to retained earnings. Okay, so retained earnings is equal to how much?
20,000.
20,000. Okay, you got it. This is our retained earnings. You got it? Any question or confusion on this? So just have in mind that the basic things of accounting. Assets equal to liabilities plus owner's equity. You got it? Anyone has any question? Okay. Finally, today I had a plan to discuss one question. This kind of questions, maybe in the exam. I will post the exam today, the pre-class quiz and after class. Okay. So, an accountant failed to record $10,000 of salaries on January 31st, 2018. What is the impact, sorry, of this omission in accounting equation, income statement, balance sheet? Okay, let's discuss this one. An accountant failed to record 10,000 of salaries payable. Okay, so what would be the impact on accounting equation, income statement, and balance sheet?
In the accounting equation, the liabilities would be understated.
In the accounting equation, liabilities should be understated. And
Statement will be over.
Assets would be overstated.
asset is overstated.
Yes.
So to solve this kind of problem, first, what should have been done? Salaries expense $10,000. Salaries payable 10,000. Okay. So this sorry, this should have been recorded, but they did not record this. So what would be the impact? Now, if we don't record this one, what is the impact? Sorry. See, on the accounting equation,
So the live.
Yes. On the
Oh, so the salaries expense is going to affect the essentially the owner's equity portion. So the owner's equity would be overstated, and the salaries pay, and then liabilities would be understated.
yes, and in the income statement, but see that in the accounting equation, we don't have an impact because we did not record. Can you see that? In the accounting equation, we don't have any impact. Do we have an impact on the accounting equation? Because we did not record.
No.
So on the income statement, what would be the impact? So
Net income would be overstated.
net income would be overstated. Correct? Because we did not record it, we did not record an expense. So net income should be overstated. Correct? Hmm?
Yes.
And in the and in the balance sheet,
Liabilities would be understated.
liabilities would be understated. Yes. So this kind of problem may be in the exam. So I'm just giving a hint. Okay. Okay. So anybody has any question for this today? Okay. So no more today. Have a good one and see you next week. Oh, one thing. Next week we will not have the scheduled meeting. I will upload 2 videos for the next week's classes. Okay, is that fine?
Thank
Okay.
you.
So we're not having in-person meeting or on Zoom?
No, there will be no in-person meeting on Zoom next week. Okay, I will upload 2 classes by Monday, next Monday.
Okay.
Okay.
Also, is this video from today going to be posted in Learn?
Yeah.
And also this document as well, the chapter 3 document?